The subject of this video is Treasury bills versus Treasury money market funds. A ladder of 1 to 3 month Treasury bills purchased at the weekly Treasury bill auctions will generally provide slightly more income than a U.S. Treasury money market fund that owns Treasuries when the federal funds rate is steady or in a declining cycle. One reason is that the investor avoids the expenses of a mutual fund and receives the same yield at auction as all other participants in the auction, including the largest institutional buyer. Another reason is that having an equal amount in a 1, 2, and 3 month Treasury bill ladder will have a longer weighted average maturity than a Treasury money market fund that will take about 30 days or so to completely reflect a Fed rate cut. The 3 and 6 month bills are auctioned each Monday. I've been participating in both almost every week now. I will also sometimes buy the 4-month Treasury bill that is auctioned on Wednesday and the 1 and 2 month Treasury bills that are auctioned on Thursday. I will also occasionally buy the 1-year bill, which is auctioned once a month. These bills do not have coupons. They are sold at discounts to par value, and interest is the difference between par value and the amount paid for the bill. However, when the Fed is in a rate hiking cycle, the Treasury money market fund will at some point during that process provide a higher yield than this 1 to 3 month Treasury bill ladder. The timing will depend on the expense ratio of the money market fund and the amount and number of the Fed rate increases. Automatic reinvestments can be set up at several brokers. I have several that I can use on that I use, which will minimize the hassle of doing manual rollovers using a ladder approach until you have to do something to renew for an additional period. My highest yielding Treasury money market fund is the Vanguard Cash Reserves Federal Money Market Fund Admiral Class, and the symbol is VMFXX, which has a 7-day yield as of 11/15/2024 at 4.62%, compared to the same kind of money market fund at Fidelity, symbol SPAXX, that has a 4.31% yield as of last Friday. The only reason I have the Admiral class is that I pick up literally just 1 basis point in yield compared to their investor class. It really doesn't make any difference. But it's just enough difference for me to do it. The yield difference between the Fidelity and Vanguard Treasury funds, money market funds, is due to Vanguard having a lower expense ratio of 0.1%. The yields of the money market funds have quickly adjusted down in response to the Fed rate cuts. The Vanguard fund was around 5.25% just prior to the 50 basis point cut on September 18, 2024 in the federal funds rate, while the current yields reflect the 50 basis point cut because all the Treasury bills and all the Treasury securities owned by these funds had already matured by now. More decline will happen in the coming days to reflect the 25 basis point cut made on November 7th, I think it was. I'm expecting the Fidelity SPAXX fund to decline to somewhere in the 4.1 to 4.15% range before the Fed meeting on December 18th, 2024. If the Fed cuts by 25 basis points at that meeting, which is still the more probable than not forecast made in the federal funds futures contracts, the yield will quickly fall below 4% for that money market fund. All of the foregoing is causing me to increase somewhat my purchases of Treasury bills just as an alternative to keeping my idle money in a money market sweep account at my brokers. I've upped my purchase to $20,000 in Treasury bills at the auction on Monday. That would be $10,000 in the 3-month and $10,000 in the 6-month, up from $15,000 in the prior auction. I discussed my Treasury bills, corporate bonds, and municipal bond purchases in my blog, which is published weekly, along with most of the common and preferred stock transactions on the U.S. and Canadian stock exchanges. Buying Treasury bills is only a very short-term response to lower short-term yields. I lengthened my duration of my bond portfolio, which is extensive, by buying corporate bonds, short-term investment-grade corporate bonds that may mature in 1 to 5 years, and by owning a fair amount of high-quality Tennessee municipal bonds with my average credit rating of being AA, or it could be as high as AA plus now. If you live in a state with a state income tax, and I do not, Tennessee does not have a state income tax, and you own a Treasury money market fund in a taxable account, you need to be careful which one you choose. Some funds own only individual Treasury securities, and the dividends paid by those funds will be free from state income taxes. However, the Supreme Court held many years ago that a state may tax dividends paid by Treasury money market funds to the extent they are derived from repurchase agreements involving Treasuries. Some Treasury money market funds use repurchase agreements, at least to some degree. This matters only in a taxable account. The fund will show whether they are using repurchase agreements in addition to owning individual treasuries, and if they are, you need to look for a Treasury money fund that does not use them at all if you live in a state with a state state income tax. This does not matter to me, since I said I live in Tennessee that does not have a state income tax, so it's not something that I pay attention to for my personal accounts. I have come across the issue in family members' accounts who live in states with individual state income taxes. The issue can be of greater concern if you live in a state that will tax all dividends paid by Treasury money market fund when the income earned from repurchase agreements exceeds a threshold amount. I recall a family member many years ago, and I was had to research why they were going to have to pay an income tax on the entire amount that was paid in dividends by Treasury money market fund, and the accountant, his accountant, told me that it's because the money market fund exceeded the threshold for the state, which I think was 50%. And once it went over 50%, the entire amount was taxed by the state. At Schwab, its SNOXX Treasury Fund does use to some extent repurchase agreements, while the SNSXX does not, and also has a slightly higher yield. When I last looked, SNSXX had a slightly higher yield due to having a longer weighted average maturity, which helps when short rates are going down, and conversely will result in a lower yield compared to the other fund when the Fed is in a rate hiking cycle, because the other fund will reset at higher coupons quicker. That's probably a lot to digest just on money market funds and Treasury bills